Good morning on Bloomberg Radio, Bloomberg Television as well. For someone that writes a wonderful research note, James Bianco joins us now. Jim Bianco, president and founder of Bianco Research. Jim, I love your chart where you say, would everybody stand up, wake up, and understand that weak Japanese yen matters to American investors? Why?
The Japanese are the largest owner of treasuries, largest country owner of treasury securities. They own more than China does right now, $1.3 trillion. As they try to hold the Japanese government bond yield at 25 basis points, when every other yield in the world is going up, they're increasing their spread to the rest of the world, and they're making their currency unattractive. If they keep doing it, and the yen is down 12% in a month, it's going to have big implications for their financial markets and economy, and they're a major country, and we're all going to feel it.
Jim, what's so important here, and this begins our coverage, I'm going to say 90 days ago, of David Foulkes-Landau at Deutsche Bank, making real clear his number one concern is devaluation of currencies against an ever stronger, resilient dollar. At what point does yen tip into some form of devaluation panic where Japan has to act?
They're very close to it right now. I mean, as I said, they've moved up or lost 12% of their value in the last month. They approached 130 on the yen overnight. And I guess the BOJ's got a difficult question they got to answer. They can continue to hold their yield curve control peg at 25 basis points in the 10-year yield and let the currency go, or they can let the peg go and defend the currency. But they can't do both at the same time. And I think we're getting close to the point where they're going to have to start thinking more about their currency than they are about their yield curve peg.
Jim, do you think that people ought to be paying more attention to the consequence of Japanese monetary policy on the U.S. Treasury market, considering the fact that the Japanese investor owns more treasuries than even China, more than any other external investor?
Yeah, they should, because as their currency goes and as their interest rates go, that's going to maintain its relative attractiveness of the U.S. Treasury market. Should they let the peg go and interest rates rise a lot in Japan, and we saw that last fall when Australia abandoned yield curve control and it rose a lot of those investors that are buying Treasury securities, again, $1.3 trillion, might find attractive yields in Japan for the first time in a generation. And that will lessen the demand for treasuries at a time that the Fed is leaving the market and other people that are saying that the treasury market or interest rates or the bond market are uninvestable because of the higher rates. You're going to just lose another major player, and you're just going to compound the problems in the bond market.
What does that translate into in terms of how much higher yields can go?
You know, when you see yields do what they've done so far this year, and on a total return basis, when you factor in the yield and the price, this has been the worst year in the history of statistics. The Bloomberg Global Aggregate Index goes back to the mid-70s. It's down 10% for the year. That is an extraordinarily large move for the bond market, and it's only the middle of April. As we continue to see this happen, you have to start to worry, and I am, that there's going to be knock-on effects or unintended consequences. The bond market, the banking system, the financial system is not really designed to have the entire bond market lose 10% of its value in 4 months. Every other time we've seen this, we've always run into problems. Now, I'm not saying we have problems now, and it might be a while off. And we've also seen when you see extraordinary moves like this, I hate to say it, but they continue to go until something breaks. That's what happened in 94. That's what happened in 99. That's what happened in 87. When you had huge rises in yield, they kept going and going, and everybody kept saying it's over, and it wasn't over until something broke. And that's what I'm afraid of now, because this move is getting into that kind of territory.
Hey, Jim, conversations with you are always valuable. We've got about 60 seconds left. When you say something might break, what have you got in mind at the moment?
Well, either that the stock market wakes up to higher interest rates a la 87. I'm not talking about a crash. I'm talking about that they just recognize that higher rates are bad, or that higher rates that translate into mortgages and borrowing costs really shut the economy down fast, or some kind of a plumbing problem like we saw in September of 2019 with the repo market. This stuff is very complicated, and when you see extraordinary moves like this, you never know what kind of impact they're going to have on it.
Jim, super smart. As always, let's catch up soon. Jim Bianco there of Bianco Research. TK, off the back of a big move.